prices received data by manufacturing firms in the Philadelphia region, which, like in the New York region, went up to 34 and change from about 31. So we're far from having defeated inflation at this point.
John Ruddick speaking as we get a busy day of economic data in America. Housing starts, building permits, the Philly Fed Index, and initial jobless claims all came out this morning. Claims unexpectedly retreating. Not necessarily a good news for a Federal Reserve, where they are looking at a labor market that is still too strong for their liking. Bloomberg's Michael McKee is back with us to discuss. Mike, what is the takeaway from today's data so far?
Well, it's all kind of around the margins, and it doesn't give any one side winning argument. Obviously, John Ruddick is on the side of the Fed needs to do a lot more. This is what we're looking at. Housing starts and building permits both down, but we knew that basically because the housing market has really cratered since the Fed started raising interest rates. Philly Fed was interesting. They really slowed down. This is the third consecutive month that the Philly Fed index, business index, has fallen, and there is obviously pessimism among Philadelphia area manufacturers about the outlook for the economy going forward. You mentioned the jobless claims numbers. Kind of what's significant about that is that this was the week that they take the payroll survey. So the fact that they went down would be 1 point in favor of a reasonably good November payroll number. Now, as to John Ruddick's arguments about the Philly Fed and the prices received versus prices paid, you can see the blue there is prices received, and that has been going up. Companies are paying less for their inputs, but they are still charging a bit more. And until that dynamic changes, we're still going to be having some inflation problems, and that is what Jim Bullard is talking about. Jobless claims, you can see here, the bottom line is kind of is where claims are. The top line is continuing claims, and that's the one that we want to watch. It's looking at where jobless claims are for people who are still getting claims, not just the initial claims, and they're still somewhat higher. So we're looking at maybe people not finding jobs as quickly as possible. By the way, Lisa, I have an update on Jim Bullard. He says that his minimum for the Fed funds rate is 5 to 5.25%. The 7% is under a worst case scenario. And he did say that he expects inflation to start to go down quickly once it does start to go down.
Michael McKee, thank you. And Tom Kennedy of J.P. Morgan talking also about how a 7% type of rate would only be in a worst case scenario. He assigns it about a 15% probability. PIMCO's Aaron Brown making the case for bonds amid the worst performance year on record, writing, quote, with interest rates higher amid a challenging macro environment, we see a compelling case for bond allocations. As a recession begins and inflation slows, duration is likely the first asset class to be poised for outperformance. I am so pleased to say that Aaron Brown joins us right now. Aaron, thank you for being with us. Always a pleasure to get your viewpoint. This has been one of the key issues. We talk about the Treasury, the longer term Treasury curve rallying. You see 10 years, 30 years rallying, which is not what the Fed wants to see. So how much can you lean into that trade when that eases financial conditions and causes the Fed to go harder on the front end?
I think that exactly is the conundrum that the Fed is facing and will continue to face over the next couple of months. They don't want financial conditions to ease as they move to a slower pace of rate hikes and eventually a pause. And that sort of the cross-section between higher rates and the Fed sort of indicating that they don't want that financial conditions to ease is going to create a little bit of a pickle, because the more that we see financial conditions ease, the higher that the Fed is going to ultimately have to move rates. And so they need to really navigate their language in terms of indicating that they're moving to a slower pace because that's what the economy needs right now, but by no means do they think that this is, off to the races in terms of moving towards a rate cut. Right now, keep in mind that the forward curve for interest rates is pricing in about 2.5 rate cuts next year. It's been a significant and dramatic repricing since the last CPI print. I think that that's overly aggressive versus what the Fed is ultimately going to deliver.
And that's what basically the Fed has been saying repeatedly. No, you guys are wrong. We are not going to be cutting rates because we are concerned about how sticky this inflation is. When you take a look at how bonds and stocks have been correlated, with bond yields going down and stocks rallying and bond yields going up and stocks selling off, when does that break down, right? When do we start to see something where lower yields on the long end is bad news and comes in tandem with a real risk-off feel? That's what seems to be what you're talking about.
That's exactly what I'm talking about. In every single recession that we've had over the last 40, 50 years, we've seen stocks and bonds negatively correlated as we move deep into the recession. When you're in a late cycle environment, which arguably we've been in over the last year or so, typically you actually see bonds perform poorly as you move later cycle. The market starts anticipating Fed hikes, bonds start to sell off, and equities also can sell off in tandem. But as you move through a recession and deeper into a recession, that's when bonds start to outperform. I think that there's two necessary conditions that need to be met before we start to see that negative stock-bond correlation resume. We're probably approaching that over the next month or two. The first is really see a firm crest in inflation and start to see inflation start to move lower. We've had one print on this side, the most recent print, but we need to see a couple of more inflation prints to really give credence to the view that inflation truly has peaked. The second is that we need to see bond market volatility start to subside, and probably related to that, we also need to see the Fed start to slow their pace of rate hikes. So we're getting to that point where I think you'll start to see more of those traditional stock bond correlation benefits start to help portfolios. But we're not, we haven't certainly firmly and credibly approached that yet. And so we're really waiting for those two catalysts.
This might be a good year, 2023, for the long end of the Treasury curve. But what about credit? I mean, perhaps investment grade, I understand. But riskier credit, it's held in there. Why will that do well, too?
So I think you really need to separate credit between those that are remote default risk and those that are closer to potential default risk, have a higher probability of default. I think those companies or those credits that are high quality, that are investment grade, and that have good free cash flow generation, don't have over leveraged balance sheets, and can operate in an environment where nominal GDP growth is not exceptionally strong and potentially even negative. I think those sort of high quality corporates will do well over the next 12 months or so. You've seen significant spread widening year to date. These companies are trading at good relative valuations versus equities, and so I think that's where you want to park your bets. I would stay away from high yield.
Erin Browne, thank you so much, as always. Coming up, some market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg.
About that all day yesterday.
Time now for the Trading Diary. We need to be watching through the next week. The Fed speak continues. Jefferson, Kashkari, Evans, all on deck. President Collins speaking on Friday. Then Mester, Bullard, and George all coming up next Tuesday. And finally, the Fed minutes coming out on Wednesday. From New York, this was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, November 17th. Here are the top market stories that we're following for you at this hour. The Hawks are still in charge. St. Louis Fed President James Bullard flagging a 5 to 7% policy rate yields jump, as well as the dollar. We're going to talk to Mark Hayfley of UBS about his 2023 playbook. Retail's mixed bag. You got Macy's crushing, Kohl's disappoints. We try and find the read-through through the market as well as the consumer. And missing funds. FTX advisors find only a portion of the company's crypto, leaving lots of money unaccounted for. We're going to track the latest. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Well, here's your verdict. If we get anywhere near a 7% policy rate from the Fed, investors do not like it. You have the S&P off by over 1%.
No kidding. Well, I was talking about a minimum of 5%. Like a lot of people saw that as the maximum.
Right.
As you say, 5 to 7. 5 to 7.
That's a
7%.
big range, too.
You could do a lot of damage with 7%. The FTX story just gets crazier and crazier. I thought we were past peak craziness there, but no. I think once you get into the details, there's still a lot of crazy to come out of that story. I am just absolutely glued to it, Alex.
Yeah, a lot of crazy to come out of that. I feel like you were talking my language there for a second. I feel like that's something that I would say, but you're absolutely right. It's like we're trying to track where the money and where the loans were and then what was backed by what. It doesn't feel like there's an end to that anytime soon.
No, I think there may have been some issues with people's ability to count, but we'll come back to that. We'll talk about that. Sonali Basak's covering that for us. Katie Greifeld's been covering that for us as well. Some great coverage on the Bloomberg terminal. But let's get back to this 5 to 7%, Alex. It is our question of the day. Bullard, I think, really setting the cat amongst the pigeons, or the hawk amongst the pigeons, hawk amongst the doves, maybe. Peak rates, 7%. That's our question of the day. This is the quote. Even under these generous assumptions, the policy rate is not yet in a zone that may be commensurate with being restrictive. Basically, they took the quote off, so I can't carry on reading it. But that was basically the story, and he sees a 5 to 7% range. Let's bring in some people to talk about this. Bloomberg's Mike McKee and Ira Jersey of Bloomberg Intelligence joining us. Mike, can you just talk me through the mechanics of how you get to 7%? How is Bullard doing this?
He's using the Taylor rule, which has been a tool of monetary policymakers for about 25 years now. You input what you think the GDP rate should be and what the inflation rate should be and unemployment, and it gives you a number in terms of where it could go. Now, when Bullard is inputting the numbers, he says the 7% is a worst case scenario. We would have higher inflation for longer, basically, in a slower growth path. And so he did come out and say afterwards that he thinks we need to go to 5 to 5.25%, which is really in the range that pretty much everybody in the Fed is talking about. Chris Waller said this morning, his St. Louis buddy, that they need to do more, but they could do it at a slower pace, possibly 50 basis points. So there's kind of two angles going here. How fast do you do it and how far do you go? Sure. What's interesting is the markets still think they're going to be cutting rates next year, and all these Fed people are saying we're going to be holding rates.
Yeah, we're going to speak to Mark Hafley, who looks for a potential cut for the back half of next year as well. Nonetheless, just looking at the price action today, the 210 spread, that we're looking at 66 basis points now. Is that wide? Ira, let's just play the what if game. If we're looking at like a 7% terminal rate, or even 6, or even 5.5, what does that do to the bond market?
Yeah, so I think, well, two things. One is probably not going to be good for bond yields, and I do think that probably if we go much above, say, 5.25, then we will have a relatively substantial or continued sell-off, and at least retest the high yields that we've seen so far this cycle, and that would be really bad for bond returns. But I think importantly, and you brought this up, Alex, you looked at that 210 spread. The 210 spread, I think either way, whether the Fed goes to 5% and then holds there, or the Fed goes to 5.25, 5.5, or 7%, then you wind up with a significantly flatter and more inverted yield curve almost throughout the curve. Maybe 10s, 30s gets flat, doesn't necessarily invert, but all the rest of the curve, I think, winds up inverting a lot more in that scenario. And importantly, you mentioned, and I think this is the important thing, is regardless of the level, we're playing semantics here, right? Whether or not the Fed calibrates us at where we're at 4 3/4 or 5 or 5.25, the point is that if the Fed stays there for the better part of a year, which I think that they will, that's really where you wind up seeing better returns for the bond market, and you wind up seeing probably 10-year yields at least making their coupon, which means 4-ish%, as opposed to the massive negative returns that we've seen this year.
Ira, do you think Bullard actually means 7%? There's part of me that thinks the Fed just wants the... Yeah, precisely. Part of me thinks that the Fed just wants the equity market to sit down. We've had this big rally. That has an impact on financial conditions. Just sit down, guys. We're not going to do what you say we're going to do. It's not going to be as easy as you think it's going to be. Just kind of take it easy. Is that really the message here?
Yeah, I think the message here is just saying, like, look, if you use these tools and models, we need to have higher interest rates, right? Because remember, we're still under 4% when it comes to the actual effective Fed funds rate, right? So I think from Bullard's perspective, when he says we're not close to the range yet, we can get to that range very quickly, right? If the Fed goes, as the market is currently expecting, 50 basis points next month, and then 25 basis points in January and 25 basis points in March, well, all of a sudden we're there. So I think within the next 3 months, we're going to be more or less in that range. And the Fed, I think to your point, Guy, the Fed doesn't like the fact that we've seen equities rally back on the expectation that they're going to start cutting when there's a recession. So financial conditions certainly aren't as tight as they were, say a month and a half ago, before you've seen this big rally in a lot of risk assets. But at the same time, I think that they're also taking it as a signal that we're going to avoid a recession, right? And that from that calibration standpoint, I think is important. And how far the Fed goes will be determined in large part by the real economy, not really the financial economy, right? And I think, when you ask Mike his next question, I'd love to get his opinion as to whether or not the Fed is going to actually be able to say, hey, the economy's strong enough where we're not going to have to cut in 2023.
That's going to be a good question. I can't give you a good answer, Ira, because we don't know what the data are going to say. Bullard did say that he thought that once inflation starts to come down, it could come down fairly rapidly, which would enable the Fed to maybe pause. Then the question becomes, do you see a weakening of growth, and how do you react to that if you're the Fed? And there you're looking at a combination of unemployment and the PCE inflation rate, and it's going to be 6-8 months before we have that kind of picture out there. I don't think the Fed wants to cut. I think they believe they need to get it up and keep it up because they don't want to have the 1980s replay again of cutting too soon and then inflation goes back up and they have to raise rates again. So they're going to be very cautious about that, but I think your idea that they leave rates where they are is more likely than a cut at this moment.
I mean, but Bullard's saying he expects rapid disinflation once the process takes hold. That doesn't sound very good. Mike, what is that going to look like then for the Fed?
Well, it depends on what categories disinflate. We know that housing rents is going to stay high for a while, but if a lot of these so-called T-word, transitory word categories actually prove to be transitory in a longer term sense, then the Fed will see inflation start to fall. But they don't think that wages are going to fall very fast. The labor market still stays very tight. As I mentioned, housing stays up. And so I don't think that we're going to see overall inflation, and I don't think the Fed expects overall inflation to fall back anywhere near its 2% target in the next year or two, maybe by the end of 2024. But there's still going to be inflation pressures out there, so they will want to keep the pressure on.
Yeah, and like we've been talking about, the back half of the year for next year, still looking at cuts from the Fed. Guys, thanks a lot. Great roundtable. Really appreciate it. Michael McKee and Ira Jersey joining us from Bloomberg Intelligence. All right, coming up, we're going to follow the theme. Does the Fed terminal rate peak at 7%? We're going to talk to Megan Horniman of Verdant's Capital Advisors coming up next. This is Bloomberg.
Looking forward to the FOMC's December meeting. The data of the past few weeks have made me more comfortable considering stepping down to a 50 basis point hike.
The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
Even under these generous assumptions, the policy rate still isn't at a zone that might be considered sufficiently restrictive. To get to this sufficiently restrictive level of policy, we'll need to increase the policy rate further.
Now, St. Louis Fed President Jim Bullard pouring some cold water on the idea that the Fed's looking to ease policy anytime soon. He went on to talk about the fact that anywhere from 5 to 7% could be a good estimate. That's a pretty wide estimate. That leads us to the question of the day. Peak rate at 7%. Joining us now is Megan Horniman, Verdant's Capital Advisors CIO, with her view. Megan, a couple things. One, what would get us to 7% from the Fed? And if we're not going to get there, why would Bullard say something like that? It clearly moved the markets. We're clearly seeing a flattening of the yield curve.
Well, let's keep in mind that he did give that range, that 5 to 7%. So I think getting to a 7% would mean that the inflation pressures turn around and go back higher again. We've started to see some signs that inflation pressures are easing. We're nowhere near where we need to be. But in order to have to say we get to a 7%, it would mean that the labor market just continues to tighten, as well as maybe some of the increase we've seen in commodity prices recently filters back into the inflation data in the first half of next year. But I just think a 7% is pretty aggressive. We would lean more towards that 5 to 5.5% rate.
Megan, do you think the market is incorrect in pricing cuts from the Fed next year?
I think it's absolutely incorrect. We've been saying that for quite some time, that the market's getting ahead of itself to expect that the Fed will raise rates repeatedly until the middle of next year and then come in and cut. I think that markets tend to swing, one way or the other. What we saw was a lot of optimism around the recent softening inflation data, and then the fact that the economic climate is weakening, that people got ahead of themselves pricing in cuts for next year. The Fed has said they don't want to do it. They don't want to get back into a situation where they were in the 70s and 80s, where they were raising, and then cutting. That's not what the market wants, and I think that they've gotten way ahead of itself to price in those cuts for second half of next year.
So we're going to have to hear more from the likes of, say, Jim Bullard, who is going to really talk up more hawkishness to be able to re-rate investor expectation. Like, how do they downshift but keep cuts off the table?
Well, I think the economic data can do that as well. And while we are looking at, like I said, inflation that looks to be getting a little bit better, we're nowhere near where we need to be. And I think that investors will accept that. We got one relatively decent number on CPI, but if you look at the actual number, it still is high. So I think the Federal Reserve is just trying to remind investors that they still have a lot of work to do. The last thing to remember with what the Federal Reserve is doing is that they haven't really, or we haven't really seen the effects yet of balance sheet unwind. And when we do start to see that, I think that you'll see interest rates move higher as well here from on the Treasury side of the curve.
Megan, given what you just laid out in terms of the way the policy is going to develop, what is the asset allocation story that you think goes with that?
So I think over the next 6 to 9 months, there still is a room for a lot of volatility because the market got very optimistic in the fourth quarter of this year. It's a seasonally good time. We've got the midterm elections around us. But when we get into the first half of next year, it's going to be a challenging economic and investment environment. Right now, some dry powder is a great thing to have because we still are optimistic on the longer term for the equity side of the market. We would be careful from that large cap growth area, the tech companies, because I do think there still is price discovery, especially from a valuation multiple there in those companies. And then I would stay with that, value side of the equity market within the U.S. Also, look at the areas that have really priced in what we might expect for some economic weakness. So small and mid cap stocks in the U.S., they do look like they have some value if you have a longer term time horizon.
Where within the value specifically? Small caps have gotten somewhat of a bid, but if you're going to wind up seeing some kind of recession or a lot of pressure from rates, that's going to be the place where you don't want to be. How do you navigate that?
Well, you have to think about what's priced in. So when you look at the decline we saw this year, small and mid-cap stocks took the brunt of that. And we think that that's priced in that economic weakness. Could there be some volatility? Yes. But if you have a longer-term time horizon, you want to look at what's the most beaten down. That's reflecting that downside risk. And we think that small and mid-cap area has. So we think that that is an opportunity from a valuation perspective for the long term.
Megan, you said a moment ago that you are, in the longer term, in the medium term, more constructive on equities, but you want to have some dry powder to be available to take advantage of that. How much dry powder?
So it depends on your risk tolerance. If you're a very aggressive client, that's a little bit different than someone who's maybe a growth client or a moderate growth client. They're going to have an overweight versus their benchmark. So anywhere between, if 5 or 6% overweight to your benchmark, I think that would be efficient right now. Also remember that your fixed income allocation, when you look at a broad diversified portfolio, you're going to have some fixed income allocation. We've been relatively short with a fixed income allocation, so there will be time to reduce that, either go out from the duration standpoint or add that back into the equity market.
This is a question that kind of pairs the beginning of the conversation with where we are now, Megan, coming in from the IB. So we were talking about how the market's pricing cuts starting next year in the back half. How long do you think the Fed's going to have to stay at the terminal rate before cutting? And that really is a response to what's the hard line for the Fed when it comes to a potential recession?
I would say that they have to stay through 2023 at least. We're not expecting us to get back to any kind of inflation levels that they'll feel comfortable with before that time frame. So I think 2024 is a different story, but I think they're going to raise through the first half of next year, despite the fact that we are calling for some weakness in economic growth, and even Bloomberg estimates right now are for negative growth in the first and second quarter. So I think that they'll still have to hike into that because inflation is not going to be where they want it to be. And then I think they're going to pause. They're going to give themselves the capability to be able to come in and cut. But I think that might be either, the earliest maybe end of next year, early 2024 story.
Megan, great to catch up. Really appreciate the input. Thank you very much indeed. Megan Haldeman of Verdence Capital Advisors. Thank you very much indeed. Still ahead, the hunt for FTX's missing funds. More on the unraveling of Sam Bankman-Fried's crypto empire. That's next. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Workers at Starbucks, who are seeking union contracts, will stage a day-long strike today at more than 100 stores. They say that management isn't bargaining in good faith. Starbucks Workers United has unionized about 260 of the chain's 9,000 corporate-run sites in the U.S. Starbucks says it will respect the workers' right to protest lawfully. Porsche has finally made a modern off-road 911. The Porsche 911 Dakar debuted this week at the Los Angeles Auto Show. The car will cost $222,000 and only 2,500 of them will be made. Porsche says it sees a clear and demonstrated appetite for the kind of sports cars that can take a beating and keep going. And the Ukraine grain export deal will be extended for 120 days. It's a move that should ease pressure on global food prices. The United Nations brokered agreement allows Ukrainian grain to be shipped from Black Sea ports. Russia and Turkey also are part of the arrangement. Ukraine is one of the world's largest grain and oilseed exporters. And that is your latest business flash, Alex.
All right, thanks so much, Ritika. Let's go to crypto for a moment. You got advisors overseeing what's left of former FTX CEO Sam Bankman-Fried's empire are struggling to find missing funds. They cite poor internal controls and record keeping. I mean, this was not a good report. Bloomberg's Sonali Basak joins us now. How much of the funds can they not locate? And do we think that it was all in tokens that are now worth zero? Any hints on what it might be?
I think if you look at the declaration by John J. Ray, remember this is the man who oversaw the liquidation of the Enron bankruptcy as well to try to recoup funds. He had very strong language. He said that there was a complete failure of corporate controls. And he also cited concentration of control in the hands of a small group of people. Tracy Alloway of Bloomberg also pointed out some really interesting details in the footnotes of this filing that showed you loans that went from Alameda had gone to certain individuals, and certain amounts of this money was used to pay, according to this filing and the declaration from John Ray, to pay for personal assets of Sam Bankman-Fried as well as his deputies. So it is definitely worth a read, this filing. But remember, this is his account. If you want Sam Bankman-Fried's account, currently you can go to Twitter. He has his own account of what had happened with assets and liabilities and what had happened to the tokens in between.
Are those Twitter posts going to be a problem, do you think, Sonali? Because there's a lot of noise around this story, and in terms of the legal process, I'm wondering, and this is being raised as an issue, whether or not they actually could confuse matters further.
Yeah, the lawyers for FTX have been accusing Sam Bankman-Fried of undermining the bankruptcy process. Remember, there's been a lot of reporting over the weekend. The Wall Street Journal, for example, reporting that Sam Bankman-Fried had also tried to raise equity at one point or raise new money here for FTX. Remember, this is after the bankruptcy filing that was on Friday. That complicates things very much. But remember, FTX has made it very clear, they've been tweeting that Sam Bankman-Fried is no longer part of the company. So there is a dispute here between the company and Sam Bankman-Fried himself, and as we've reported, Guy, lots of investigations going on both here and in the Bahamas from different regulatory agencies. So how will those tweets be used is a good question.
So let me just go back to what you said before. So in this filing, it said that Alameda made loans, we think, to FTX executives.
They named them by name in the filing, and the amounts.
If Alameda wound up getting consumer money from FTX, this is like an FTX financing FTX executives in some kind of circular way. Am I reading that correctly?
It's going to take a very long time. We've tried to do at least some of this in Bloomberg reporting now. If you look, there's a story on the terminal that will show you the map of Sam Bankman-Fried's empire, because what's going to be difficult to untangle is not just FTX. FTX is 100 and some companies here across the entire globe, as well as Alameda, which has its own counterparties, and it seems that Sam Bankman-Fried and his colleagues were part of those counterparties.
Wow.
Sonali, the issue a lot of people are going to have is, if this was happening at FTX, is it happening elsewhere? Is that basically now the market's mentality around all of this?
There's something that I've been thinking about for the last 24 hours, and it's this, Guy. You're seeing a lot of companies pausing withdrawals of customer funds. There was, 8%, 15% yields promised on those funds. What were those funds used for? Were they transferred over the trading desks? And is that why those withdrawals cannot be met now? These are serious questions about the crypto industry.
a whole lot of crazy still to come out. Shonali, thank you very much indeed for your fantastic coverage. The whole team's coverage has been amazing on this. Coming up, peak rates at 7%. What could that mean for commercial real estate? We're going to talk to Hessam Naji, Marcus & Millichap, CEO, next. This is Bloomberg.
Day like Bloomberg.
We're about an hour into the U.S. trading session. We're off the lows, but markets still taking it on the chin after we floated around that 7% Fed funds terminal rate from Jim Bullard. Abigail Doolittle tracking those moves. Abby?
Yeah, rough day on that commentary because, of course, we have yields up, and that means stocks down. The 10-year yield back up about 7 basis points, speaking more to the uncertainty and the dislocation, I would say, in the part of bond traders really just not knowing what the Fed's going to do. We've been moving up and down 7 basis points frequently recently, but today this does have stocks down. Now, the real pressure on yields is on the tech space. If we take a look at big tech, we're going to see some big declines there for the likes of Apple and Microsoft and Amazon and Google. You can see here, well, we're actually off the lows, at least for Apple and Microsoft, and that's why we're off the lows for the major averages. These are the two biggest weights for the major indexes, so the fact that they're no longer down 1%, 2% means that the major indexes are off the lows, but you can see Amazon and Alphabet still a piece of that. And Amazon, of course, has the e-commerce component, the shopping component. Retail is the focus this week, and today we do have some interesting earnings winners as in contrast to yesterday's earnings not so laggard, I would say, in terms of Target, but Macy's right now up about 12%. They beat in a big way. They also boosted the profit outlook. The CEO, Jeffrey Gennette, is talking about the idea that fresh inventory is the key to keeping consumers shopping. Bath and Body Works, a similar story, up 16.7%. They beat, they boosted, and apparently they have a good mix of old and new products
Both of these stocks have 7% short interest, so there could be a bit of a short squeeze there. But Kohl's now up 3.5% in the pre-market. It had been down. This, of course, after they suspended their 2022 outlook. And then Gap, well, that's tonight, so let's see what it brings. Now, another piece of the retail story guide, and this is so interesting, of course, is the commercial real estate space. One part of that, malls. If you take a look at this mall index over the last 5 years, well, it's not doing so well, down 73%, and a big bulk of this decline happening around the pandemic as folks started to rely more on e-commerce. So it's interesting to think about all the different ways that a sagging consumer or shifting consumer trends, what it really, the impact is and where it extends, Guy.
Yeah, I did hear somebody talking about the idea that as we've come out of the pandemic, we're looking to socialize a bit more, and maybe the mall makes a comeback. Abigail Doolittle, thank you very much indeed. Let's continue the conversation around real estate. We heard from the St. Louis Fed President, Jim Bullard, a little earlier, talking about the fact that rates may need to go as high as 7% Fed funds rate to cool the economy. What would 7% mean for the real estate market? It's quite sensitive to the interest rate story. Hessam Naji, the CEO of Marcus & Millichap, joining us now. Marcus & Millichap is a national commercial real estate investment firm. If I look at the transactions they do by property type, multifamily, around a third, retail, around 40%. Hessam, thank you very much indeed for joining us today. If Fed funds rate get to 7%, how is that going to impact your business and the commercial real estate space, do you think?
That would be rather drastic for our industry, of course, and the for-sale housing industry, which affects consumer sentiment and the economy in a major way. Commercial real estate is interest rate sensitive. Typically, investors borrow 50 to 70% of the value of a purchase price. So leverage is very important, and the interest rate shock that we've absorbed in the last few months has disrupted both valuations and transaction activity. But it seems like inflation is starting to peak. We saw some evidence of that last week. 1 month is not a trend. I understand that. You saw the reaction where the market was very excited to see that trend starting to come down, and both the exuberance in the stock market, but also interest rates coming in a little bit. So given the fact that we've seen so many successive interest rate increases already, the effects of which haven't materialized in the economy yet, it takes 6 to 9 months for that to show up. And the fact that we're hearing more and more about layoffs, I think the strategy is already working. And within the next 3 to 4 months, we're going to see more evidence of that.
Yeah.
And hopefully something as drastic of a 7% federal funds rate will not be necessary to achieve the goals that the Fed wants to achieve.
Hessam, if it takes a few months more for the effect to really be felt, what area of your business is it accurately reflected now or will be hit the hardest once the recent impact of Fed hikes is really felt?
Interestingly enough, the property types that have been favored the most, which are multifamily, those are, evergreen investments with great cash flows, lots of demand, both from renters and from buyers of apartment buildings, that have had the lowest yields because of that buyer demand, as well as industrial warehouses, which again have done extremely well and have had terrific buyer demand and therefore the lowest yields. Those two asset classes are affected the most because the interest rate increase really brought in the spread to their yields versus the cost of borrowing much more drastically than recovery plays like retail. Shopping centers had higher yields because they were less favored, and therefore they're now absorbing the interest rate shock a little bit better than these more favored asset classes. But the pricing is already recalibrating. Investors are very creative. They're using more cash and less leverage to buy assets that are available now that would not have been brought to market. And they're also patient. They're looking at the long term beyond the next 12 to 18 months once we get past this sort of adjustment period in the economic cycle whether interest rates have to go back to more of a normal level, they're looking at the yields that are going to be behind this particular chapter. So we're seeing a lot of buyer demand. The velocity of trading has been affected as the market recalibrates. And retail, we spoke about retail a little bit earlier before we got on. It's the comeback kid. Because of the resurgence in fitness, entertainment, restaurant attendance, the pent-up demand from consumers wanting to come back out.
Yep.
And I'm not surprised to see some of those positive numbers.
Yeah, we've had Macy's today. We've had maybe less positive numbers coming out from Kohl's today. Walmart obviously looking fairly strong as well. We spoke to Dana Telsey about the issue of retail the other day, and she had some interesting points. Hassam, just let's have a listen to what she had to say.
The holiday season, for the most part, is going to be about gathering. I think people want to be together more than they ever have in the past, but I think it's still a challenged holiday season economically. Yes, the retail sales figures came out, but you have a real bifurcation between the high end and the low end.
Hassam, what do you make of that idea that people do want to get back out there? You just mentioned the fact that people are going back into more social environments. They're going to restaurants, they're going to bars, they're going to cinemas, etc. To what extent does that include retail as well? Is that part of the retail story? Are the malls going to come back? Are these big retail sites going to come back?
They really are coming back as we speak, but not in the old form that is obsolete. A lot of investors have bought older shopping centers. They're re-tenanting them. They're repositioning them as great investments because now they draw in a whole new demographic that wants that entertainment, wants the restaurants and bars, and reasons to go out and experience things, not just buy things. And so that reinvention of retail is in full force. And there's some category of retail that is completely going through a reuse, where a shopping center or a mall, an obsolete 1970s, 80s style mall makes no sense, but something else can be put in the place of that real estate with a complete replacement of that real estate. That's how retail is reinventing. One other point to make, very importantly, retailers have adjusted. They have less inventory. They need smaller footprint. Part of the reason Macy's beat by so much this quarter is because they've gone through the pain of reinventing their if you will, core business.
Well, Hassam, to that point of reduced floor print, like they already did that. I feel like we're now seeing that with tech. Layoffs after layoffs being announced, and they're going to have to shrink their floor print at the same time. Have you started noticing that within the tech industry yet?
We've seen it in tech, and we've seen it in other categories, in fact, other types of tenants, as we're hearing from our office owner clients across the country. There is a big push to shrink footprint, and there is a big push to reinvent that category of real estate also, with office space now becoming more of a team-oriented configuration, lots of amenities to attract people coming back into the office in the lobby area and common areas. And so the office is going through its own, if you will, revolution, but it's way behind retail because prior to the pandemic, we weren't hearing about the need to reconfigure office spaces drastically as we are today. And I think in the next 2 to 3 years, there's going to be pain in the office sector. But beyond that, with a new economic cycle post this recession worry and interest rate normalization, that cycle will start to bring in new demand.
All right, Hassam, we really appreciate it. Really wonderful insight. Hassam Najdi, Marcus & Millichap, CEO. Thank you so very much. We'll get you next time as well. All right, coming up, we're going to take a look at how those higher rates are affecting companies servicing the residential real estate market. Hayes Barnard is Goodleap founder, chairman, and CEO. We'll talk about some solar panels next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. It's a power shift in Washington, although not as big as Republicans had hoped for. The GOP has won a narrow majority in the House that gives them the ability to block President Biden's agenda. House Republican leader Kevin McCarthy tweeted that Americans are ready for a new direction and Republicans are ready to deliver. Democrats had controlled the House the last 4 years. And in the UK, Chancellor Jeremy Hunt has outlined $65 billion in tax hikes and spending cuts so the government can plug a hole in its budget. The wealthy will be hit with higher taxes on wages and dividends. Meanwhile, a windfall tax on oil and gas companies has been extended. And Macy's reported third quarter earnings that beat estimates. The department store retailer also raised its guidance for the full year. That's a sign that it has succeeded in luring in shoppers despite consumers shifting away from discretionary spending. Bloomberg spoke with Macy's CEO.
What we're seeing is a return back to the 2019 pre-pandemic buying pattern for the holiday. That's why we're really saying, what does that mean for Thanksgiving? What does that mean for Cyber Week? What does that mean for the last 10 days before Christmas? So we're adjusting our plans to accommodate anticipated higher peaks.
And Macy's has been more successful managing its inventories than other apparel peers. That's due in part to digital tracking and a lack of private label goods. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg Alex.
All right, Ritika, thanks very much. All right, let's go back to the housing data. You got new home construction dropping in the U.S. in October. You got higher mortgage rates really wrecking some demand in the housing market. Let's get some derivative plays on this. Hayes Barnard is GoodLeap founder, chairman, and CEO, and Bloomberg Shelley Bassick joins us now as well. So GoodLeap provides financing for the residential solar energy industry as well as other clean energy inputs. Hayes, it's great to get your perspective on this because if mortgage rates are going higher, my house price is going to be going down. I'm going to be feeling less wealthy. People are going to be buying less houses. How does that affect solar installations?
Yeah, it's a great question. So here are the trends. Obviously, interest rates are up. We're talking about the Fed. The first trend is consumers are paying about 14% more for electricity at their home. And so they're thinking about, okay, how do I lower my costs? How do I fix those costs? How do I get more energy independence to take control? And the last piece is exactly what you said. They're not going to move. They don't want an 8% interest rate. So they're thinking about, how do I upgrade my home? How do I electrify my home? What are the things I can do? And so the good news is our value prop for the consumer hasn't changed. We can still save them money. And the main reason is that those energy costs have come up. Our costs are coming up too. You can't fight the Fed. We've had to adjust our pricing, but we still can save consumers around $50 to $100 a month by lowering their electricity bill and electrifying their life.
So how do they make that trade-off? Because on one hand, it could have long-term effects on lowering some costs tied to bills, but interest rates are also going up. So if you're borrowing to make some improvements, how much more is it costing them to make those improvements?
Yeah, so it's costing them more. I would say the average system size has increased by a few $1,000s. But remember, we're financing this over a 25-year period of time. And so that monthly payment has come up a little bit, but is in direct correlation to the cost of power that they're paying on their utility bill. So they're still saving about 20% on their electricity bill by using new electrified solutions in the home, whether that's energy efficient HVAC, whether that's solar, battery storage, taking control of those energy needs, creating their own independent energy loop, for their EV car and things along those lines. And so we're seeing a lot of demand. If you look at the Inflationary Reduction Act, that's driven a lot of awareness. People are saying, look, okay, I have a stable 30% investment tax credit now. That's given us some good education in the marketplace for consumers that say, okay, I'm interested in doing this.
Well, you mentioned the Inflation Reduction Act. You also talked about inflation more largely. What's the net effect? What are the dollars that are being moved from consumers in this environment that we're in with these two forces, the ability to help via stimulus versus the ability to not spend because their other bills are higher?
Yeah, that's a great question. So I would say discretionary spending, as you've seen with Target and all the recent announcements, is clearly slowing down. Now you have this non-discretionary component, which is energy. People have to pay for electricity. What are they going to do? And so we're constantly competing against that utility bill, that cost of power. And so they're making conscious decisions to think, okay, I'm paying a lot more for food. I'm paying a lot more for gas, different things. What can I do in other areas of my life to lower my cost structure, fix those costs over longer periods of time?
Hayes, good morning. It's Guy in London. What do you think the long-term cost of power is going to do over the next 25 years? Is it going to go up or is it going to go down?
Well, Guy, my utility company has never called me and said, hey, surprise, we're going to lower your electricity rates. And so I think it's definitely going to go up. It's going to continue to go up over the course of time. Utilities are dealing with a lot of things, right? They need to bury their power lines. They have an aging infrastructure. A distributed grid is really important, but we also have to make sure the utilities are funded incredibly well. And so the utilities, when you look at rate structures throughout the country, they have a real challenge. They're trying to think about how do they pay for an upgraded infrastructure. And so I think we're going to continue to see utility costs rise, as we have. And so we've got to think about doing both things. One, supporting those utilities, making sure they're well funded, but at the same time having a distributed grid that will create more reliability and more control for consumers moving forward as we put a lot of load on the grid. Remember, there's a lot of electricity coming on the grid from EV charging infrastructure and other things in our lives that we're electrifying. So we've got to be really thoughtful about how to handle those increased costs.
How geographically dispersed is demand for solar? Is it in the sunnier parts of America? Are all parts of America experiencing a boom in this? I'm just wondering how this works, how different parts of America, how different parts of the world are going to adapt to this energy transition.
So I would say every state in the United States is dealing with an energy increase, and it's even more severe if you get really tight. Like in Florida, there are certain areas that are dealing with 30 and 40% increases. And so if you look 15 years back, it primarily started in California, Arizona, Nevada. Now we've seen it scale throughout the rest of the United States. We're seeing a lot of demand in areas like, Missouri, Illinois, all over kind of the Northeast. And so people are becoming more educated about how do I get rid of this old, outdated water boiler or various items in my home? What do those rebates and incentives look like for me to replace it? And then how much did it actually reduce my energy costs?
What do you do with the loans that you make? They get packaged up, they get sold to investors. What kind of investors and what's the demand like right now?
Yeah, so if you kind of look at the overall platform, we've got 25 large financial institutions that buy these loans on forward flow on a regular basis. And so we bundle those loans on a warehouse line. We don't take any credit risk, but then we deliver those loans into the market. And so, today we do several $100 million a month of those loans. And here's the good news. The banks and financial institutions that are buying these loans, they love the asset class. It performs less than 80 basis point default rates, which is less than 1%. And so we've seen no increased risk in defaults or delinquency in any way throughout the pandemic or during these times. Go figure, people don't want to pay more for electricity. And so where a lot of the fintechs have had to put these assets on balance sheet, there is no demand for these assets, created real challenges for those organizations. We continue to deliver these assets to the marketplace through major financial institutions, the sovereigns, insurance companies, the traditional banks, the specialty banks, and more leaning in to say, okay, we like this asset class. We trust the performance of this asset class.
Hayes, what about your investors in the private rounds of your company? You have this decision to stay private, at least for now, wondering if an IPO is around the corner. What types of investors are you courting, given that you have already secured the likes of MSD, that's Michael Dell's firm, and Byron Trott's firm? Is it mostly high net worth that is coming to the fore here, as frankly, we've seen a lot of the venture industry get caught in a lot of trouble lately?
Yeah, I was very thoughtful about the cap table and making sure it's a patient group of people. And the reason that we chose some of the names that you had is they really support entrepreneurs and let those entrepreneurs focus on growing and scaling their companies. As you know, a lot of companies that IPO'd over the past year are dealing with a lot of distractions and a lot of difficult things by being a public entity right now. We really thought about it long and hard last year. We decided to do a private round. Both MSD and BDT, as you said, were investors in that round. And it's allowed us to remain very focused on operating the business and winning the markets and thinking through, taking our time for growth and how we want to kind of strategically take advantage of the rails and the pipes that we've built. If you think about it, we have about 500,000 customers on the platform right now, 25,000 companies that are on this platform. We add about 150 companies a month that are saying, look, we want to go to the tablet, we want to go digital. How do we finance these assets in a more strategic way than we have before? And then we're bringing more of the financial institutions on the back end. So we're well capitalized. We're being patient about if we go public and when we go public, and we're grateful for a strong investor base.
Hey guys, thanks a lot. Really interesting conversation. I could go a lot longer with that one. Hayes Barnard, a Goodleap founder, chairman, and CEO, thank you so much. And Bloomberg Schneider-Bassek, thank you as well for joining us. This is Bloomberg.